Tax season is here again, and I'm going to go out on a limb and say that you aren't that excited about it. Well, it doesn't have to be as painful as getting a Brazilian wax with superglue. In fact, we're going to hear 5 tax tips that may help DIY investors lower their tax bills and, dare I say it, maybe even start to look forward to tax time. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for a 3rd straight year and counting. I'm your host, Rob Moise. Pleasure to have you here with us. We're going to dig into those 5 tax tips for DIY investors, and later on, we're going to take your questions about tax strategy in our live Q&A, so stay tuned for that. But for now, let's dig into it. Joining us is Jason Heath, founder of Objective Financial Partners. He's a certified fee-only financial planner with over 20 years of experience, and he also shares investing and tax insights as a columnist with the Financial Post and Money Sense, among others. Jason, it's a pleasure to have you back on the show with us. Friend of the show, always appreciate you taking the time.
I appreciate it. Great to be back. Brazilian wax with super glue. Is tax that bad?
I really wanted to paint a picture. I know some people feel like it's like ripping off a really uncomfortable Band-Aid here. So I like to get visual with things here. Yeah, well, listen, when there's people like yourself helping them through it, maybe it ain't so bad. But in any case, excited to get into the tax issues here. But listen, I'd be remiss if I didn't ask you about the tariffs that are just absolutely rattling the markets right now. We've seen the major North American indices, they're down yesterday, down sharply again today. NASDAQ's in correction territory. TSX is flat on the year. And I feel like there's a lot of people out there freaking out. So what are you telling your clients?
Well, look, I wish I had a crystal ball to predict the future, because Trump is pretty unpredictable, and that's really rattling the markets. But I think stocks are sort of the same. Stock markets are tough to predict, and I think it's worth considering, Rob. If we look back a year, the Toronto Stock Exchange and the S&P 500, I think, are still both up double digits year over year. The S&P 500 maybe isn't in US dollar terms, but it is in Canadian dollar terms, and I'm sure a lot of people would have been happy if you asked them a year ago if a 10% plus return would have been a good outcome. So I think my advice tends to be the same regardless of what's going on in the markets. If you're invested in stocks, I think you need to have a long-term time horizon. If you're contemplating selling stocks today, maybe you're right. Maybe stocks go down 10 or 20 or even 30% from here. But this might also be a bottom or close to it. And I think the challenge with selling and moving back into the markets in the future is you then need to be right twice. You need to pick the right time to sell. You need to pick the right time to buy. And it's hard enough to be right once, let alone twice. Even the professionals have a really hard time with market timing, let alone, sort of self-directed investors and lay people. So I think my approach is generally that at any given time, whether markets are up or down, you should try to have the appropriate amount of stocks versus bonds. When stocks go down, you should be buying. When stocks go up, as they have until recently, you should be selling and rebalancing. I know that's sort of a generic answer, but I think it's honestly the best way to build long-term wealth. It should be a boring process rather than a knee-jerk reaction. But definitely lots of people that are worried about what's going on, and hard to know where we go from here.
What I'm hearing from you here is, listen, if your plan was XYZ, stick to XYZ, right? Like nothing really changed with you. It's just the markets that have changed.
I think that's it. And, hopefully in a year, let alone, 10 or 20 or 50, it's not going to matter. Even for somebody who's approaching retirement or into retirement, I know sometimes those people worry because, okay, I don't have a year, like I'm in drawdown mode. But generally speaking, those people are only taking hopefully, 2, 3, 4, 5% out of their portfolio every year. That means the other 95, 96, 97, 98% of their money is still invested for an eventual recovery. So I think that's an important way to look at it, and just try to stick to the plan. Ideally, you want to hold a similar asset allocation whether markets are up or down, and if you react with a knee-jerk approach, you run the risk of selling low and buying high, which is sort of the opposite of what you really want to do.
All right, so you're cool as a cucumber while people are panicking in the market here. I like to hear
Doing
it.
my best. I'm not paying attention to my own portfolio. I'm in the middle point of my accumulation journey though, so easy for me to say. But it's the same message that I would give to any client who was into retirement mode. Just be careful. And I think the one thing I will say is if the recent volatility has caused somebody to become really uncomfortable, it begs the question whether they had too much in stocks in the first place, and maybe they should be modestly reducing their allocation to stocks on a permanent basis, not increasing it after markets turn around and go back up again, because that can be sort of counterintuitive.
Right. Okay. Well, appreciate you opining on the moment here. Crazy things in the market. I'm sure there's going to be lots more to talk about in the future. But let's talk tax right now. That's what we have you here for. And one of the things I wanted to pose to you too, maybe a hot button issue around the tax filing deadline here, is that many Canadians are going to receive a tax refund at some point. And surveys have found that over the years, they tend to spend those refunds. What would you say to someone who's saying, yeah, what's a big deal? I buy myself a new iPad, maybe I go on a vacation rather than investing it. Why do you think they might want to consider doing something more productive with that money?
Well, look, I think it's a fine balance. I think if you are hitting your savings targets, otherwise, I have no problem with spending it. And you might expect a financial planner to say, oh, save it, do something smart with it. But no, again, if you're hitting your saving targets on an annual basis, you're on track for retirement, you're on track for whatever other goals you're saving towards, I think it can be okay to spend it. And I do think you need to balance sort of living for today and saving for tomorrow. But by and large, I think if you get a tax refund and you've got high interest rate debt, that would be the first thing that I would be focused on paying down before, I would look to invest it, frankly. And we're going to delve into some of these other things, Rob, I know in some of our questions today in more detail. But I think the quick story is if you're saving for a home, FHSA is a great option. If you've got a company matching contribution on an RSP or a company pension plan, or you're in a high tax bracket, RSP contributions or pension contributions with that tax refund makes sense. I think if you're a low income taxpayer or your RSP is maxed out, TFSA would definitely be a logical option. But again, main thing for me is people are hitting their annual savings goals as opposed to saving every penny that comes into their hands.
Right on. Okay, so you teased some of those tax tips we're going to talk about here. So let's get into the heart of our conversation here, those 5 top tax tips that can help people squeeze out a little bit more value from their portfolios during the fiscal year. And for those in our audience who want to get in on the conversation, we'd love to have you too. So make sure you submit our questions for Jason. If you're watching on Webbroker, you can use the chat box there. If you're watching on our broadcast platform, use the questions and comments box. And if you're watching us on our YouTube live stream, you can click on the link in the description. It's going to take you over to the broadcast platform, and that's where you can ask your questions. Without further ado, Jason, let's get into it here. And your first tax tip is to contribute to the investing account that best aligns with your financial needs, even, and here's the rub, even if it isn't the most tax efficient option on paper. That might sound counterintuitive to some people. So can you walk us through your thinking here?
Well, I think in particular the older members of the audience who were around before TFSAs really grew up with the idea that you should always max out your RSPs. And I think there's really 3 schools of thought around RSPs. There's those people who will always contribute the maximum because they want to get a refund regardless of any other considerations. There are people I come across at the other end of the spectrum who would avoid RSPs because RSPs are bad and you're going to pay tax when you take money out, and they prefer their TFSAs. And the group that I think has it right are those who use RSPs as they are meant to be used, which are tax tools to be considered annually, whether it's contributing to your RSP strategically in the right years and also withdrawing in the right years. And I think, very simply, if your income is relatively high today, especially if you think it will be lower in the future, contributing to an RSP makes sense. And some people may say, well, I don't know, I assume my income will be lower in the future. I think it's the sort of thing you can try to run some projections on your own. Professional financial planners, that's one of the things that they do. But ideally, high income today, low income down the road, RSP contributions makes a lot of sense. But I think one of the challenges is if your income is modest, you could run into a situation where trying to get that tax refund and trying to max out your RSP is counterintuitive. It might actually put you in a situation where you get a small tax refund today, which feels good, but then you pay more tax on the withdrawals later on. And over the course of your lifetime, you might have been better off skipping an RSP contribution in a low income year and saving it for a future year, or maybe investing in a TFSA instead of an RSP. So all that to say that I don't think maximizing today's tax refund or minimizing today's tax payable is the best approach. My favorite approach is trying to minimize your lifetime tax, which sometimes takes a little bit of work.
What about for those folks who are just crushing it out there, right? They're high income earners, they've maxed out their tax sheltered accounts, they're looking for other ways to lower their taxable income. One of the things that I've heard you suggest is that they could consider a spousal loan. How does that work?
Yeah, so a spousal loan is kind of interesting, and I'll try to walk you through an example. I think we might throw an example there up on the screen, but say you've got a situation where somebody's got $100,000, let's call him Bob, that he can invest on his own and he can pay tax on that income. He's a high income earner. He could loan that money to his spouse, Stacy in this case, and she could invest the money instead. And the opportunity that exists really is that, if you've got a lower income spouse, you can effectively move income onto their tax return. And some people might say, well, look, why doesn't Bob just give Stacy money to invest? And it doesn't work that way. There's something called attribution, spousal attribution, whereby if one spouse gives money to another spouse to invest, the income gets attributed or taxed back to the giver of the money, so to speak. It doesn't apply with our RSPs. It doesn't apply with TFSAs. It does apply with a non-registered account, a taxable investment account. So Bob can't just give money to Stacy, but if he loans money at the CRA prescribed interest rate, which is currently 4%, Stacy can invest that money and hopefully earn a higher rate of return. And to try to boil it down and make it really simple, if you can loan money to your spouse at 4% and they can invest it at 8%, that 4% differential effectively gets moved from one tax return over to the other. And the thing with spousal loans is they were a real big thing a number of years back when interest rates were low, sort of pre-COVID. The prescribed CRA interest rate that needed to be charged on that loan between spouses was 1%. Right now at 4%, it's not as compelling. But if interest rates continue to go down and these tariff issues continue to plague the Canadian economy, we could see a 3 or a 2% spousal loan interest rate that might allow people to engage in some income splitting between high and low income spouses.
Would you say that there's, generally speaking, like an interest rate where this starts to really make sense versus not make sense? Is there like a line in the sand there?
I think it depends to a certain extent on the individual. So if somebody is a high risk, low fee investor, they've got their self-directed brokerage account at TD Direct Investing, they're all in, super comfortable with stock markets and volatility, the interest rate can be higher and there can still be a benefit. On the flip side, if somebody is a relatively conservative investor, you imagine somebody who's got like a 50-50 stock and bond portfolio. If they're going to loan money at 4% to their spouse, and that spouse is going to try to earn a higher than 4% rate of return in order to make a profit or reduce tax on the delta, there may not be a lot of opportunity there. So I think if somebody is a moderate risk investor, the interest rate needs to be lower for it to make sense. And the other thing is, the tax saving opportunity may not be that big for $10,000, but if we're getting into, hundreds of thousands of dollars, then it can be quite compelling over the long run.
Okay, so it sounds like there can be some moving parts here. Perhaps someone considering this might want to speak with like a tax expert or a financial planner, kind of make sure they got all their ducks in order before they do this. Anyway,
No,
Jason,
look,
let's move on to
100%.
Yeah, absolutely. So let's move on to your second tax tip here. And this one is an interesting one. It's to contribute to a first home savings account, or FHSA, if you're eligible to, of course, even if you don't intend to buy a home. Now, why could that be a savvy tax strategy?
Well, look, I think the FHSA is a great opportunity for somebody who is buying a home. You can contribute, you can claim a tax deduction. The money grows on a tax free basis. And ideally, if you are actually buying a home, you can take a tax-free withdrawal from the FHSA for an eligible home purchase. So it kind of ends up being like an RSP on the way in, a TFSA on the way out. But even then, even if you're not in a position where you are think you're going to buy a home, it generates effectively extra RSP room, and that extra RSP room, is a tax deduction, a tax deferred opportunity, and you can transfer money from an FHSA into an RSP if you don't use it within the standard 15-year time frame. I think by and large, most people using an FHSA first home savings account genuinely intend to use it to buy a home. But again, the backup plan is it's a way to get more money into your RSP, so it's not necessarily a bad opportunity to consider.
Yeah, I mean, I got to say, I'm a little bit jealous because I didn't get to take advantage of this account. I missed it by like 2 or 3 years or something like that, but whatever. I guess I got a home out of it, whatever. What about the parents, though, in the audience here? Because I can see a lot of them being really excited about the FHSA. They want to help their kid out with a down payment. Is there some way that they could use the FHSA and then also lower their household's collective tax bill at the same time?
Yeah, I think that's the key. I mean, there's nothing wrong. I mentioned the concept earlier about attribution. There's nothing wrong with giving money to a child to invest once they're 18 years of age. There can be attribution issues for minor children who are under the age of 18, but you need to be 18 to open an FHSA. And a parent who has money that they can afford to give to a child, especially if it's in a non-registered account and they're paying tax on that money anyways, and especially if they're intending to give money to a child to use for a home down payment, you could give them money to contribute to their FHSA account. The result is the child gets a tax deduction, not the parent. The child gets a tax deduction. So the family as a whole pays less tax as a result. And the challenge that I come across in talking to parents about this is some are hesitant to give $8,000 to make the maximum annual FHSA contribution to their 18-year-old. Some are very comfortable doing it. Even those who have responsible children hesitate about sometimes giving too much money too early, for example. But one of the strategies I really like is I've seen people who do like a matching contribution. In other words, encourage the child to put in $4,000 from whatever savings they're able to accumulate, and then mom and dad match another $4,000. So I don't think that's the original intention of the FHSA, to help people with lots of money to contribute to the account, but certainly it's an option that's available to a family who can afford to do so.
That 50-50 contribution strategy sounds a lot more sensible. Particularly, thinking about myself, I wouldn't have given me $8,000 at 18 years
Right.
old. So anyway, something for the parents in the audience to consider there. Listen, Jason, we got a lot more tips ahead here, but before we continue, I just have a quick question for our viewers. Do you like free stuff? And do you like free stuff that can help level up your investing skills in particular? Well, then check this out.
The TD Ultimate Investor Contest is officially live. Canadians can enter today for a chance to win a black iPhone 16 with 128 gigabytes of storage, a check for $500, a book kit featuring 5 educational books on investing, and a 1-hour private Q&A educational session with a TD Direct Investing Education Manager. To enter, visit the TD Direct Investing Facebook page, follow TD Direct Investing, and like the TD Direct Investing contest post dated March 24, 2025. You can also gain a second entry by following TD Direct Investing on Instagram and liking the TD Direct Investing contest post dated March 24, 2025 there as well. There's a limit of 1 entry per entrant per social platform. The contest runs until April 22nd, 2025. Scan the QR code for full contest rules and details.
Make sure to get your entries in. It's a fantastic contest. All right, Jason, your third tax tip, let's keep this train rolling here, is to hold U.S. domiciled investment products, things like U.S. stocks, U.S. ETFs, within an RRSP if that account makes sense for your given investment goals. Why is the preference for the RRSP here?
So I think this one needs a little explanation. For some investors, Rob, obviously they may only have an RSP and should probably just focus on a diversified portfolio. But if you've got multiple accounts, it can make sense to look at holding U.S. stocks or exchange traded funds, U.S. exchange traded funds that own U.S. stocks. So U.S. ETFs that trade on the New York Stock Exchange as opposed to the TSX, for example. And if you own U.S. stocks in a non-registered account or a TFSA account, a non-registered account, you pay a relatively high rate of tax on U.S. dividends. Canadian dividends get taxed at a lower rate. In a TFSA, there's 15% withholding tax on U.S. stocks. But one place you can sort of hide away your U.S. stocks is in an RSP. There is, in the tax treaty between Canada and the U.S., the opportunity to have tax-free dividends, U.S. dividends that are earned in that RSP. One of the keys, especially these days, some self-directed investors in particular may come across Canadian listed CDRs, Canada Depository Receipts. They're US companies that have actually been repackaged and trade on the Toronto Stock Exchange. And these CDRs technically are going to have 15% withholding tax on US dividends before they hit the fund. And same thing with TSX listed US stock ETFs. They're going to have 15% withholding tax before the dividends hit that fund, regardless of where you own it. So buying a US listed US stock ETF or a US listed stock means no withholding tax. And I think the one sort of caveat and the thing that maybe I want to clarify a little bit, Rob, is that, even though there might be a tax opportunity there, US stocks generally pay low dividends. And like right now, the S&P 500 dividend yield, I think, is about 1.3%. And the Toronto Stock Exchange TSX dividend yield is about 2.7%. So some people will gravitate towards owning Canadian stocks in a taxable account because the tax rate is lower. But if you're paying a lower rate of tax on a higher dollar amount of income, you may or may not come out ahead. So it's not you can't paint everything with the same brush. I think you need to look at it on a case-by-case basis. But by and large, there may be an opportunity with U.S. stocks and U.S. listed U.S. stock ETFs in your RSP.
Okay, so again, what I'm hearing is don't let the tax tail wag the dog, right? You just keep that in mind as one consideration. Yeah.
Don't live by it. Yeah.
Okay, good stuff. Let's move on to your fourth tax tip here. This is to diligently track the cost basis of investments held within non-registered investing accounts. What the heck is a cost basis, I think, is the obvious question a lot of people might have, and why is it important?
I mean, most people don't have to worry about it because they've got RSPs and TFSAs. They don't have taxable accounts. So what we're talking about here is non-registered or corporate accounts where there's tax payable when you sell an investment for a profit. And so what we're talking about is the adjusted cost base, or ACB. On your brokerage statement, it might be called book value. And it gets kind of tricky when you're trying to figure out the ACB for US or foreign investments, because you need to calculate it in Canadian dollars based on the time of purchase. So if you buy a US stock and you sell it in the future, you've got to go back and figure out what the US Canada exchange rate was at the time you made that purchase, even if it was 10 years ago. And the Bank of Canada has a good lookup tool for investors. And you can actually end up in a situation where you buy a stock for $100 US, sell it for $100 US, and there's no profit effectively in US dollars. But if you bought it at a 1.1 exchange rate and sold it at a 1.2 exchange rate, you might have actually bought for 110 Canadian, sold for 120, and you've got a $10 Canadian capital gain. And as a Canadian investor, you need to report all of your income converted to Canadian dollars. Now, brokerage statements usually get the ACB right for Canadian dollar investments, in my experience, not always. But a lot of times for US dollar investments, they'll just report it in US dollars. So you may need to do some work to convert to Canadian dollars. Some people track their own adjusted cost base ongoing, or at least double check it just to make sure their brokerage records are accurate. But again, the real challenge comes with foreign stock and foreign investment purchases and sales.
Right. So this sounds like do a little bit of work up front, avoid a lot of headache later, potentially, right?
That's it. Yeah.
Okay, great stuff. Now let's move on to your fifth and final tax tip here for us, and that is to consider deferring the tax deductions earned from things like RRSP, FHSA contributions to a later year. How could that help someone lower their tax bill?
So I think this is kind of an interesting one that most people aren't aware of. And normally when you contribute to an RSP or FHSA, Rob, you report the contribution in the year it is made. Well, not normally, always you report the contribution in the year that it's made, but you don't need to deduct the contribution. You can contribute and report the contribution. You don't need to deduct it. And most people have a similar income from year to year, so they might as well deduct the contribution in the year it is made. But if you've got an extraordinary spike in your income that you foresee, ideally in the short term, the next year or two, you might want to defer a deduction. And, one example could be a business owner that when they're actually getting around to doing their taxes, they realize their income was lower or their deductions were higher than expected. So as a sole proprietor, their income on their tax return is a bit lower. They might decide to delay an RSP deduction. Another great case, I think, would be a young person. We talked about contributing to an FHSA for an 18-year-old. Most 18-year-olds have little to no income because they're at school. So they can delay deducting that FHSA deduction until they're in a higher tax bracket and working. And sometimes you can end up in a situation where, delaying a year could save you an extra 10 or 20% income tax.
Yeah, that FHSA example that you point out, I think that could be really meaningful for someone just kind of starting out their career and stuff like that. Like every penny counts, right? So delaying the tax deduction there can make a lot of sense. Really appreciate you sharing all those tax tips with us, Jason. Might be too late for people to kind of take advantage of some of these for this fiscal year, but it's, with tax, you always want to plan ahead, right? So good things to think about for this fiscal year coming up here. I want to move on to a segment that we have called Hot Takes, all right? We've heard a lot of interesting perspectives on our program in the past. I want to bounce some of those ideas off of you, see if you agree or disagree. How does that sound? You're up for it?
It sounds good. I'll tell you what, though, I feel like we've done this before, and I've heard the hot take and gone, how do I diplomatically disagree? So we'll see if I agree or disagree this time around.
All right, well, let's see this first one here. This is from Reese Martell from Well Built Wealth. And he says there's a so-called RRSP meltdown strategy, which basically involves drawing down your RSP before you kind of touch other income sources in retirement. That can be something that can really help people lower their taxable income.
So if you wanted $50,000 a year in income, you're going to take none of that from CPP and OAS and anywhere else. You're going to push those off, and you're going to pull $50,000 a year from your RSP, well, plus the taxes, right? And then when you hit age 65, then your CPP and your OAS come in and whatever else. And let's say that's now $30,000 in income. All you need to do is top up that $20,000 from your RSP. But now you've shrunken the size of your RRSP considerably in those earlier years so that you won't be left with that tax bomb that we talked about.
All right, Jason, so what do you think about this RRSP meltdown strategy? Is it something that can make sense or not worth the hassle?
So look, I think what Reese said there definitely has merit. I'm a supporter of early strategic RSP withdrawals, particularly when they're coupled with CPP and old age security pension deferrals. And, for some people, deferring RSP withdrawals until age 72 may be impractical because they need the cash flow. For others, if they've got a relatively high income, it can definitely make sense to defer RSP withdrawals till 72. But for most sort of average people with modest incomes, I think taking some level of RSP withdrawals in your 60s, especially if you retire in your 50s, can make a lot of sense up to that 50,000-ish sort of second tax bracket. Or possibly, depending on someone's income and assets, up closer to 90,000, where the old age security clawback limit begins. But it also depends if they can qualify on low income for low income benefits like guaranteed income supplement, for example. It depends if their income and tax bracket is going to be similar in the future as it is today. But I think one thing that I would clarify, I think Reese may have said there, 50,000 plus the tax. It's 50,000 pre-tax generally would keep you in the lowest tax bracket. So I think in a lot of cases, the planning that we do with clients, we try to at least use up that lowest tax bracket. And it's tough. It's sort of a niche area because I find most investment advisors aren't super well versed in tax and particularly in decumulation. And most accountants aren't super well versed in retirement and investment strategy either. So it's an area that I love to live in and my team loves to live in because it's, this pre and post retirement planning with a tax overlay is super important. And for all the self-directed investors there, it's on you. You got to figure this stuff out too. So, but by and large, I agree with that strategy.
Okay, so you didn't even need to break out the diplomacy there. You were on board with it. Okay,
No.
There you go.
Good answer, Reese. Good answer.
All right, well, I got one more for you. This one comes from Neil Winokur, aka the Grumpy Accountant. That's his moniker. And he says there can be big tax benefits for entrepreneurs who incorporate and invest using a corporate account.
Let's say your living expenses are, I don't know, $80,000 a year, and you're making $150,000 a year of profit. So you can leave $70,000 every year in the corporation and be taxed at 12.2% instead of the higher personal tax rates, which in that bracket could be 35% or 30, 35, 40, right? There's definitely an advantage. And what people don't realize is that in your corporation, you could actually open an investment account and have investments, stocks and bonds, and you can earn dividends and interest and capital gains. Then you'll still pay high rates of income tax on that investment income every year, but you'll have more principal to invest in the first place.
All right, Jason, so corporate accounts, yay or nay, generally speaking, what do you think?
Yeah, look, once again, we're 2 for 2 here. I largely agree with this. And maybe just to elaborate a little bit, the idea is if you have a corporation and you're running your business through that corporation and you have money in there that you can choose to leave in or pull out, you might pay 20 to 50% personal tax to pull money out of your corporation. Whereas if you leave money in there, the small business tax rate is generally between 9 and 12%, depending on the province, and there's a few other caveats. But the whole point is there might be 10 to 40% tax deferral to leave money in your corporation. And there is a catch there that Neil may or may not have got to if we watch more of the clip. But generally speaking, if somebody's an incorporated business owner, it makes sense for them to contribute to their RRSP or TFSA and max out their RSP and TFSA. And if you contribute to your RSP, you can even avoid that 12.2% corporate tax that he alluded to. If you contribute to your TFSA, you're conceding upfront tax. You're paying more tax to pull money out and pay personal tax on that withdrawal from your corporation. But generally, over the long run, the tax savings is worth it. So I definitely agree with the message that you should defer personal tax by building up money in your corporation, especially if you have maxed out RSP and TFSAs. And I think one important thing Neil said there as well was you can buy, stocks, bonds, etc. And I'm shocked how many people I come across that have corporate bank accounts where they've saved up a bunch of money and they haven't invested it. So they can definitely open up a brokerage account and put it to work, and they definitely should. Okay,
so something to consider there. So 2 for 2, hey, I like it, that's good. Appreciate you opining on those hot takes there, Jason. I want to move on to our next segment here, and we were talking about the importance of keeping track of things like your cost basis and all your tax documents and stuff like that. So on that note, I'm going to throw it over to my colleague, Caitlin Cormier. She's going to show us how you can find some of this stuff in WebBroker.
To find your tax documents in WebBroker, we're just going to come to the top right-hand side of the screen, click on Settings and Services, and click on Documents e-Services. You may see this link all throughout WebBroker and can always click on e-Services to get to this page. Once we're here, we're going to select Tax Documents. You'll notice there's a drop-down for Account, so you can choose which account you're looking for documents for. You can choose a specific tax year, or you could choose all or multiple. When you're ready with your search information, just go ahead and click Search. You have the option here to just select a document and view it, or you can actually click on multiple documents and download those documents to your computer. You have the option to update delivery preferences if you wanted to receive your tax documents by mail. There is no charge for that, but just keep in mind you won't see them online if you choose to receive them by mail. If you have any questions about your tax documents or this whole tax process, you can come to Accounts, over to Self-Service and Tax Information Center. Here is a hub with information about different tax documents, filing your taxes, different account types, lots of information here to answer a number of your questions about taxes and filing your taxes. If you can't find your answer here, instead, you can go on Webroker, click Contact Us, and you'll see that we have our phone number for our trading desk, and you can give them a call and ask any questions you may have.
All right, thank you so much for that, Caitlin. And Jason, we've covered a lot of tax ground here. Now it's time to open the floor and hear what our viewers want to know about. You ready to get going?
Let's do it.
All right, so our first question here comes from Greg. And Greg wants to know, if you have a superficial loss, does the capital loss just get included as part of the adjusted cost base for that stock, as opposed to being able to offset the loss against any capital gain?
So good question. So the way that a superficial loss works is if you sell an investment at a loss and you repurchase that investment within 30 days, or your spouse or common law partner for that matter, the loss is denied. It's as if it never happened. And basically, if you imagine a situation where you sell an investment for a loss, repurchase it within 30 days, because you never effectively sold the investment, at least in the eyes of the Canada Revenue Agency, your cost base remains identical to what it was previously. There is a really neat opportunity to transfer losses between spouses by intentionally exploiting the superficial loss rule. So if you've got a spouse with a loss that they want to move over to another spouse, the first spouse can sell the investment, the second spouse can buy the investment within 30 days, and the original adjusted cost base from the first spouse moves over to spouse number 2. And as long as they wait 30 days, they can sell and trigger the loss, which could be advantageous if the second spouse has a higher income or they've got capital gains that they want to offset. But basically, when you trigger a superficial loss, it's as if the investment was not sold in the first place.
That is a really nifty loophole to utilize there. Probably takes some doing to think through. So again, like maybe somebody like a financial planner or a tax expert could help you out with that if you're interested in doing that. But really nifty strategy. Appreciate you sharing that, Jason. Let's move on to our next question here. This one's coming to us from Jeff. And Jeff wants to know, I'm a 60-something retiree and I'm in the process of drawing down registered savings plans. Is there a yearly tax rate that I should target or a drawdown by a certain age?
I wouldn't say a drawdown by a certain age necessarily, and I don't even know if I would say a certain tax rate. I think I would base it in part on, trying to project out what your future income is going to be. And maybe to use an example, if somebody's got a relatively large RSP and they retire at 60, and they've got a ton of TFSAs and non-registered investments, and if they were to forgo their RSP withdrawals until age 72, because you don't need to take money out until you're 72 years of age, they could have a relatively low income during their 60s. Their RSP could grow for another 10 years, could be twice as big, and then have a really high tax bracket in their 70s and their 80s. So in a situation like that, I would probably, again, be trying to use up that first tax bracket, generally up to around $50,000 of taxable income. But I don't think there's one right answer. In some cases, if somebody's going to have a really high income in the future, I alluded to earlier, it might be going up to the OAS clawback limit. But I think the key is to try to minimize your lifetime tax rather than your tax this April, and to try to smooth your income out a little bit over time. And it's the sort of thing where you can try to do some back of the napkin stuff on your own, or certainly that's what professional financial planners generally do with their clients as well.
Yeah, generally speaking, we want our golden years to be pretty stress-free. So if we can smooth things out from a tax perspective, all the better, right?
You got it.
Let's move on to another question. This one's coming to us from John. John says, I purchased a US stock in my unregistered account, or non-registered account, I should say. What I didn't notice when I bought it was that it was a limited partnership. And when I sold it, I had 37% withholding tax and then an additional 10%. Can I recover any of that 40%? 47%, I should say.
It's a complicated question, and what I mean by that is, first off, if you have foreign withholding tax on an investment, on a piece of real estate you've sold, on foreign employment income, whatever the case may be, generally a Canadian taxpayer can claim a foreign tax credit. A foreign tax credit is meant to reduce the tax payable on that income in Canada, and generally speaking, avoid double taxation where you're paying tax in both countries. So in a lot of cases, if you have 20% withholding tax on something somewhere else in the world, you'll pay 20% less Canadian tax on it here because of that foreign tax credit mechanism. US limited partnerships can be a little bit complicated. I know that there are some cases where you may actually be required to file a US tax return as a result of owning an investment like that, which makes them not ideal to own in a taxable account. So I think that's one piece of advice that I would seek, to see if there's a US tax filing requirement as a result. And it may be that you're not able to claim all of that tax on your Canadian tax return. You might only be able to claim 15% tax, which is a common, tax treaty rate between the two countries, and you might need to get the excess tax back as a refund from the IRS. The challenge is, it might cost you more in accounting fees to file your 1040 tax return in the US, 1040 NR as a non-resident, than you get back in tax refunds. So certain investments like foreign limited partnerships, US limited partnerships in particular, master limited partnerships, often they're called MLPs, you've got to be careful about. It might trigger a US tax obligation.
Okay, I got to admit my head is spinning from all of that, but look at you, unflappable in the face of a very complex question there, Jason. Yeah. Well done. We have time for one more question. This one's coming from Akemi. Akemi says, I sold some Apple stocks inside my RRIF and I invested in US dollars and I sold in US dollars. How do I figure out the exchange on that?
Well, look, I think for fun, if you wanted to figure out the exchange rate, check it out, look it up on the Bank of Canada, see what it was when you bought and sold. But because that happened in a RIF account, a registered retirement income fund, you don't have to worry about tax. RIFs, RSPs, TFSAs, when you sell and you have a profit on an investment, you don't report that on your tax return. It's just non-registered accounts, corporate accounts, trust accounts, like taxable investment accounts where a capital gain matters. With a RIF account or with an RSP, the tax implications generally are withholding tax on the dividends and then withdrawals. When you take a withdrawal from the account, it doesn't matter how that withdrawal came to be. It doesn't matter whether you bought and sold Apple shares or you invested in GICs. Every dollar you pull out of a RIF is taxable income that gets reported on your tax return. But the capital gain, the buying and selling and profits on investments within a RIF don't matter for Canadian tax filing purposes. Okay,
so thank you for clarifying that. So Akemi, don't worry about it. It's all good. Appreciate you taking questions from the audience there, Jason, and sharing your expertise on all things tax strategy. Fantastic conversation. We always love having you on. We hope to have you on again soon. So thanks for joining us. And for those in our audience too, we really appreciate you tuning in. Make sure you tune in next week. We got an interesting episode coming up here all about stock picking. DIY investor Brian Feroldi, he's going to share some of the stock picking red flags that you want to watch out for, help you avoid some of those duds and instead invest in ones with better potential. So make sure to tune in for that. As well, too, remember, you can check out the TD Ultimate Investor Contest as well. Make sure you sign up and get those entries in as well. And you can check us out as well, Inside Investing, on social media with TD Direct Investing. We're on YouTube, we're on Facebook, we're on Instagram. We got QR codes up on the screen here. You can give those a scan, check us out, follow us. We'd really appreciate it, and you can check out some upcoming content that we have, as well as a ton of other content designed to help you become a smarter investor. On that note, we're going to say goodbye for today. Thank you so much for tuning in. We'll see you all next time.
Have more questions? Check out the links to the right and in the description below.